If you look at all the franchises, FNB, RMB as well as Westbank perform quite well. And it's just an indication of execution of our strategies which we embarked upon probably from 2009 already.
How are you seeing the customer at this stage? Because from all accounts, the South African consumer is still very much under pressure, still highly indebted. Are you starting to see them come back to the bank to borrow money and help you grow your assets?
They are slowly coming back. And what we are doing is to target on those customers that we believe have more runway in terms of further growth opportunities. So the mass market is very important. The upper income segment is quite important. And the low defensive areas in the wholesale credit or the corporate credit environment is also important. And those are the areas that we are focusing on, and we're seeing some growth there.
You have been targeting specific niches within the market. So, for instance, the high net income individuals, you bought part of BJM last year. How is that helping you to grow the base there? What sort of response are you seeing to that?
Well, for starters, we managed to retain all the customers that BJM brought along. And secondly, we're able to offer a more comprehensive offering to our customers in the retail segment, in the high income segment, particularly in areas that we didn't have before. For instance, retail stockbroking, we're now able to offer that. And we're able to grow our offering in terms of offshore opportunities that exist, especially with some relaxation in foreign exchange opportunities.
Are these customers you find haven't been as impacted by the recession of the previous couple of years and also by the high debt levels that we continue to see in South Africa?
Clearly that segment, the high income segment, will have a lot of entrepreneurs, people who are self-employed and so on, who are still doing relatively well, whose companies have strong balance sheets, and that's why we continue to benefit from there.
Of course, this is a new look Firstrand, so the first results since you unbundled Momentum into MMI. How do you see the relationship with the insurance stable, well, with Momentum and OUTsurance perhaps going forward from this point?
We actually expect to sell more insurance products using the bank platform or infrastructure, mainly because the arrangements and agreements that we've reached with both Momentum and OUTsurance allows us to keep 90% of the profits or the revenues actually that we generate out of selling insurance. So there's a better incentive infrastructure or structure, which then allows our people to be incentivized to sell more of those products.
So it's not the end of bank assurance per se?
Not, absolutely not.
Perhaps going through some of the segments, where are you seeing the strongest growth coming through, particularly in the retail segments? If you look at FNB, if you look at Westbank, your credit card division, where is the growth really coming from at this stage?
The number of things that we're focusing on. For starters, we recognize that in an environment where customers are highly indebted, they are looking for value for money, and therefore we're migrating customers to low-cost electronic channels. And we see a growth in the transactional volumes that we're generating out of that. Clearly, it does have the negative impact on non-interest revenue, but on the other side, we believe in the long term, it is exactly the right thing to do. The mass market continues to grow quite nicely. Customers in that category are typically under-geared, as well as in the wealth segment. So those are the kind of areas that we focus on. And if you look at the Westbank franchise, it's very good and it's very established in the dealer network of motor vehicle sales. And therefore, as we see the uptick in motor vehicle sales, Westbank naturally benefits.
Well, your impairment's down by 35%. The scope for further improvement, because it doesn't seem to be coming through across the board. It seems to be more on the credit card side and the wholesale side where you're seeing the biggest improvements, particularly between June and December last year.
That's correct, because if you look at the larger book of home loans as an example, the slowdown in non-performing loans is slower compared to credit card or the other areas, mainly because we've got the debt counseling process, which is lengthening the process that it takes to collect monies from customers. And in fact, when you analyze that book further, you'll find that it's those accounts that were made or the loans that were made in 2007, 2008 that are still experiencing a bit of hardship.
So do you expect this impairment ratio to continue coming down at this pace, or do you think you've got the low-hanging fruits already and it's going to slow down a little bit? Well,
it is certainly going to slow down, especially because, if you look at the interest rate reduction season, we think that's probably behind us. And in fact, we may be looking at a flat interest rate environment going forward, even a risk of interest rates starting to come up by the end of the year or early next year as inflation starts to rear its head.
Do you think the consumer will be in a better space by the time we do see these interest rates going up again?
Not necessarily, because if you look at the disposable income to debt in the consumer space is still quite high. And that would suggest that customers would find it difficult as interest rates start to go up to actually meet their obligations or even spend on new activities.
Perhaps looking at a couple of the key ratios, your return on equity close to 19%, so gaining some traction there. If you think back a couple of years, we had ROEs in the banking sector in the mid-20s. Do you think we can get back to that space, or do you think that the new capital pressures on banks, such as Firstrand, is going to keep you from getting back to those very high ROEs of the past?
The good old days of ROEs that were somewhere between 25 to 30% in our case are certainly over. But in our case, we continue to focus on improving ROEs, and therefore we think the more sustainable levels are somewhere in the lower to mid-20s.
Do you think as you get more clarity on the Basel III capital requirements that you will be able to hold less capital than you're holding at the moment, because it has been building quite nicely? It's obviously capital that could be employed elsewhere, though.
Well, there's still uncertainties in that regard, because as soon as the Basel III process is completed, we should get a better sense, understanding that clearly there's going to be local requirements in terms of the local regulator may require additional buffers to be held in addition to what Basel III may typically require. And we need to get a bit of clarity in that regard. But you can assume that clearly as we become more certain in terms of how much capital we're going to require, and we've addressed our strategy and therefore the capital that's going to be deployed in all the activities that we are pursuing, there may be opportunities for us to return capital or back to our shareholders.
We talked about the South African consumer and how they're feeling at the moment. How about the African consumer outside of South Africa? Because this is an area where you are trying to grow your presence. You're in negotiations in a number of countries. You are growing your presence in a number of countries. How are you seeing growth in Africa outside of South Africa?
Growth, in fact, is quite strong in a number of countries. We look at our franchise in Namibia and Botswana, Swaziland. The companies there is doing quite well. Our business is doing quite well there. We're looking at further opportunities to grow our platform in Mozambique and Zambia, and we're pursuing growth opportunities in Nigeria and Tanzania as well as Angola. And our business in India is actually doing quite well because it's leveraging off the increasing trade flows between India and the rest of the African continent. So we see nice growth opportunities coming out of those operations.
What sorts of new opportunities are you looking for in Africa?
Typically, we're looking at establishing franchises. In other words, we're looking at establishing full banking services that would range from retail banking to investment banking. So we're using our franchises in FNB, RMB as well as West Bank to find opportunities in these different countries. Clearly, infrastructure and resources are a big factor in driving economic growth in the continent, particularly in the countries that we're focusing on. And we are particularly looking at those, which is why India and China then becomes quite important because the resources as well as the infrastructure story will be driven by investments and flows from China and India into Africa and vice versa.